If you spend 5 minutes on social media, you'll probably see video after video talking about how real estate is the best thing since sliced bread. And in a lot of ways, it can be. I bought a rental property 3 years ago, and it's one of the best investments I've made. But there are definitely drawbacks to owning real estate. So in this video, I want to provide you with 4 reasons you should and should not invest in real estate. Hi everyone, my name is Angelo Cirinelli, and I'm a financial planner in Verona, New Jersey. So let's start out with 4 reasons why you may want to buy a rental property, starting with cash flow. Everyone loves the idea of waking up to more money in their bank account, especially when they don't have to put much effort into getting it. So you may hear about cash flow, but what is it? Well, put simply, it's the profit generated from renting out your property. If rent is $1,000 a month and expenses and money set aside for reserves are $800 a month, then $200 is your cash flow. When running numbers on a real estate deal, it's important to calculate the true cash flow though, which is the rental income minus the mortgage, property taxes, insurance, and reserves for maintenance and vacancies. Not setting aside some kind of money in a rainy day fund from the monthly rents is a recipe for disaster. Because what happens when the AC unit needs to be replaced for $7,000 or when the roof has to be replaced for $15,000? This is why it's important to have reserves. When running numbers on a property, you should think about the long-term averages of various maintenance expenses. Month to month, the profits from rental properties can be lumpy, as some months there are no maintenance expenditures, while other months there are a lot. The correct amount of money to set aside for maintenance and vacancies will really vary based on the age, size, finishes, and fixed expenses of the property. The great thing about fixed expenses, though, is that these costs, for example, the mortgage payment, stay the same if you have a fixed rate mortgage, while your rents typically increase, making it easier to cover your debt payments on the property over time and generating more cash flow. However, costs for things like maintenance and insurance will go up over time, so not all of the rent increase is pure profit, but a good chunk of it is. Next up, if you're using a mortgage to buy your rental property, then you can get the benefit of equity growth through paying down the mortgage every month. A typical mortgage is amortized, which is just a fancy way of saying that at first, most of your mortgage payment goes towards interest, but over time, more and more of the payment goes towards paying off the debt. Using more debt can increase your return on investment at the risk of becoming too over-leveraged and not having the cash flow to cover your debt payments if your real estate investments hit some speed bumps. There are a lot of people who wish they used less debt in the lead up to the housing crisis of 2008 because bankruptcy is no fun. Now we get to the third reason for buying real estate, which is the tax benefits. Operating expenses for rental properties such as insurance, property taxes, maintenance, and property management are expenses that can be written off on your taxes. Now, depreciation is another benefit of owning real estate. And you may be thinking, wait, real estate depreciates? I thought everyone buys it because it appreciates. Well, to understand what's going on here, we have to separate real estate into the land and the structure that sits on top of that land. Land doesn't break down. After all, when was the last time you had to call a repairman to fix worn out land? However, the structures that sit on the land, like houses and garages, do wear down over time and require repairs. To account for this, the IRS allows you to claim losses every year on the structure as a write-off on your taxes. So what's the point? Well, you can make a profit and through the use of depreciation, claim a loss on the rental so that you pay less or even no income taxes on that income. Now, as with all things that have to do with taxes, there's much more to this, and depending on your income level and profession, you may not be able to use depreciation to offset your active income. So depreciation is beneficial when you're holding the property. The trade-off is that if you sell at a profit, you must pay taxes on what's called depreciation recapture. The solution? Either don't sell or perform a 1031 exchange. This enables you to sell a rental property, buy another one with the money from the sale, and defer most or even all of your capital gains taxes. You can keep doing this over and over so that you never have to pay taxes on the gains from your real estate. And if you die, then your heirs can get the properties at a stepped up cost basis, and depending on the size of your estate, no estate taxes may be due. So Mark Twain once said, "Buy land, they're not making any more." This quote is true to an extent. Yes, more land is not being made, volcanic islands notwithstanding, But what matters most is the location of that land and your rental property on top of the land. For instance, why is New York City so expensive to live in? Because many of the people want to live there and there's a finite amount of space. This in turn causes the price of real estate to appreciate due to demand exceeding supply. It's important to note that real estate appreciation is speculative and no one can predict what appreciation will be in the future. Some years values go up, stay the same, or sometimes even go down. But over the past 30 years, the average home appreciation rate across the country has been a little over 4%. However, when using a mortgage, your returns can be even higher. Now here's an example. If you buy a house with cash for 100 grand, and I know 100,000 is pretty unrealistic, but let's just keep the numbers simple here, and the property appreciates by 4% over the year, then you just made a 4% return on your $100,000 investment. Now let's say that you instead put 25% down, which is 25,000, and finance the rest of your $100,000 purchase. Fast forward a year later, and the house is appreciated 4% to $104,000. Your return is no longer 4%. It's 16% since you only put 25,000 of the $100,000 purchase price down. Add in the cash flow, debt pay down, and tax benefits, and your returns can be even higher. Of course, when borrowing money, this introduces more risk, so before doing this, you should fully understand the risks involved. Okay, so those are reasons why you would want to think about investing in real estate, but what are reasons you wouldn't want to invest? Well, first of all, just to get into a property takes a lot of money. Even if using a mortgage, it can cost $100,000 for the down payment and closing costs, unless you're buying in some place like Detroit. In addition to this, there are major expenses associated with the ongoing use of a property. As an example, it cost $12,000 to replace the roof on my rental property a few years ago. Thankfully, I ran the numbers so to ensure that the income from the rents would pay for the expense, but what if the tenants left? Well, then I'd be left paying the mortgage and replacing a roof. As another example, the advisor I work with owns a commercial property and his tenants were committing fraud. So he had to evict them and was stuck paying $7,000 a month on the mortgage, property taxes, and insurance until he could re-rent the space. So just like having an emergency fund is important for your personal life, so is having an emergency fund for your rental properties. And I know some people may say, well, what about using a home equity line of credit to pay for things? And the fact is that HELOCs aren't guaranteed. During the 2008 economic crisis, banks were withdrawing lines of credit left and right, so you shouldn't be relying on a loan to bail you out. So do you like the idea of owning your own business? Because this brings me to my next reason why you may not want to invest in real estate. Even though the IRS classifies rental income as passive income, owning a rental property can be anything but passive. Dealing with tenants, toilets, and termites can be a major hassle. And sure, you can use a property management company to make it more passive, but that's going to eat into your return. And at the end of the day, it's your property and you need to make sure that it's being managed properly. Real estate is a business, and if you're self-managing, you'll need standard operating procedures and trusted contractors to ensure that your real estate business is profitable. Even if you only have 1 or 2 rentals, you'll want to be on top of your properties to ensure that the tenants are taking care of them and that you're being proactive with maintenance so that a small leak doesn't spiral into a massive mold remediation project costing tens of thousands of dollars. So are you looking for large amounts of cash flow immediately? Well, hopefully not, because that brings me to the third reason why you may not want to buy a rental property. So large amounts of cash flow is all relative. After all, at the beginning of the video, I used cash flow as an example of why you would want to buy real estate. And if you were making $100,000 a year off a rental, you'd probably be pretty happy. But what if you had to invest $10 million to make that $100,000? This equates to a 1% cash on cash return. And if all you care about is cash flow, then at that rate, you'd probably be better off buying a broad market ETF for a more passive and higher return than this example property. Now, of course, cash flow isn't the only reason to invest in real estate, and depending on the property, you may get solid cash flow, especially years down the line. But one of the reasons why real estate is popular with the wealthy is because it's usually more of an equity play than a cash flow play. And equity isn't taxed until you sell, which is where a 1031 exchange comes in to defer taxes. Alternatively, you can do a cash out refinance where you borrow against the property and live off of the borrowed money, but that can introduce a lot of risk since at the end of the day, you have to pay that money back plus interest, and currently interest rates are pretty high. So, have you ever needed a lot of cash fast? More cash than you had in your bank account? One of the benefits of a stock is that usually you can get rid of it quickly when you need to free up some money. However, if you buy a rental property on a Monday and need access to that money on Thursday, then you're gonna have a bad time. In most instances, it's going to take at least a month to sell your property and most likely much longer unless you're willing to take a haircut on the price. So with rental properties, you're in it for the long term, which is why the phrase location, location, location rings true. If you have a rental and need to sell but the location is bad or you're underwater on your mortgage, then there's a good chance you'll be stuck with it. And that's a very expensive mistake you don't want to make. Alright, that was 4 reasons why you should and should not invest in real estate. In summary, 4 reasons to invest in real estate include cash flow, appreciation, tax benefits, and debt paydown. And 4 reasons to not invest in real estate include it requires a lot of cash, owning real estate is a business, you probably won't get large amounts of cash flow at first, and it can take a while to sell or otherwise pull money out of the rental property. So did this make you want to invest in real estate even more, or did it make you realize this isn't for you? Don't forget to like, comment, and subscribe. And if you'd like to discuss anything I covered in this video, please reach out to get your questions answered for free. My contact info is below in the description. Alright, thanks for watching, and I'll see you next time.